Hello everyone, we are the Cryptopunks, and today we are going to present our research on the impact cointegration of cryptocurrencies and equity indexes has on portfolio diversification. There is no doubt that crypto has caught the attention of many investors globally. With that remark, our research motivation was to find out if investors who are looking to run a mean variance efficient portfolios can benefit from crypto diversification. We also wanted to investigate the correlation between major technology indexes and cryptocurrencies. Does it have a correlation? And if so, is there a specific vertical equities which show co-integration with crypto? So let's dive in.
Our research question is very important for investors in today's financial markets. Large institutional investors like pension funds are wrestling with the idea of investing in cryptocurrency. However, investing people's retirement money in risky cryptocurrency is hard to rationalize. On the left here, we see the investment profile of traditional investments that portfolio managements are looking to invest in. They have visible and stable cash flows and low volatility. But on the right, we see why on the surface, these types of long-term investors have stayed away from crypto historically due to high volatility, lack of free cash flow returns, and the fact that it's hard to value. Despite these characteristics, we have seen a rise in institutional investor interest in cryptocurrency in recent years, with many looking to enter positions. Given this, institutional investors like large pension funds and university endowments need to better understand the correlation profile of cryptocurrency with other assets to ensure that they are optimizing their portfolios for their clients. Our research will help investors understand the risk and co-integration of cryptocurrency with major technology sub-industry ETFs, and whether or not cryptocurrency can provide diversification benefits and optimize mean variance efficient portfolios. This idea falls under Markowitz's portfolio optimization theory, which in simple terms optimizes portfolios quantitatively by ensuring all eggs aren't placed in the same basket. Our research will show whether or not cryptocurrency can add value to these portfolios, that is, if they are not co-integrated with other assets like technology stocks and ETFs that we are looking into. So our research will test for this co-integration in two key ways. First, it will test whether major cryptocurrencies are co-integrated with the NASDAQ 100, a major tech index, and second, it will test whether they are co-integrated with different technology sub-industry ETFs, such as robotics, cybersecurity, clean energy, and semiconductors. To recap the premise of our research question and how assets can contribute positively to mean variance efficient portfolios, this occurs when and if cryptocurrency and the technology ETF are not co-integrated, and this will create diversification benefits. However, if they are co-integrated, then these benefits are limited. Our method is unique and original. Our method tests the relationship of major cryptocurrencies with multiple technology ETFs, not just the NASDAQ technology index in general. This methodology will allow us to gain unique insights and analyze the exact types of technology assets and exposures cryptocurrency has a relationship and is co-integrated with.
In the last few years, there's been a lot of emerging literature on the relationship between cryptocurrency and equity indices. Here we examine various papers with differing views on the topic. Firstly, Kostika and Laupodis examined 6 cryptocurrencies in conjunction with major stock market indices. They found no evidence of co-integration between cryptocurrency and the stock market indices they examined. As a result, Kostika and Laupodis concluded that cryptocurrencies represent good portfolio diversification opportunities for potential investors. Similarly, Mund and Tucker attempted to investigate the connection between Bitcoin and Asian stock market indices from July 20th, 2010 to April 26, 2019. From their study, Mund and Tucker found that market indices in Japan, Korea, Singapore, and Hong Kong never negatively correlated with Bitcoin. Overall, they concluded that Bitcoin was suitable for long-term investment rather than short-term, offering an alternative to Kostika and Laupodis' conclusions earlier. Taking Mund and Tucker's findings one step further, Fonda suggests that cryptocurrency and stocks look increasingly correlated. She stated that Bitcoin's correlation to the S&P rose from 0.01 in 2019 to 0.36 in 2021, indicating that the asset classes were moving closer together. Fonda found that Bitcoin, Ether, and the S&P 500 all rose on the same day, further proving in her eyes that equity indices and crypto appear increasingly connected.
It is important to note that originally crypto developed as a fast, simple, and affordable way to transfer money internationally, and since should be considered as a technology and not just a currency. Tu, Chan, and Zhang found that there are many similarities between crypto and high-performance technology stocks, and still a large literature gap of the research with regards to the correlation between the two. Furthermore, even though in 2020 there were several attempts to find correlation between crypto and other tech stock indices, according to Benson 2022, more recent research show and highlight that the correlation between crypto and tech stock is much higher than ever. Not only that, but many suggest it is trading as a tech stock and not so much as digital gold anymore, all which does support the grounds of our research.
In order to determine the level of dependence which the price values of the selected ETFs have on the values of our chosen cryptocurrencies, we use a vector autoregressive model by fitting each cryptocurrency as a linear combination of p-lagged values of the ETFs. In order for the VAR model to provide reliable results, three key assumptions must be satisfied. First, residuals must follow a white noise process. We conduct a portmanteau test on the null hypothesis that residuals are correlated with previous T and conclude this assumption is satisfied. Second, data must be homoscedastic. This is difficult to achieve in stock markets and other financial assets due to the presence of volatility cycles, causing indisputable heteroscedasticity within these asset prices. An Arch-Lagrange multiplier test against the null hypothesis of homoscedasticity confirms this assumption is violated. However, when working with cointegration, it is arguably sensible to ignore this assumption as its violation will have little serious impact on our results, as argued by Lee and Say 1996. Finally, a non-essential though beneficial assumption is the normality of residuals, which a Jacques-Berger skewness and kurtosis test on the null hypothesis of normality confirm is not satisfied. The maximum lag order was determined through iterations of a Keiki information criterion, finding an optimal maximum lag of 2 for modeling Bitcoin and Binance Coin, and of 3 for Ethereum. Our models show that, as well as being dependent on themselves, the crypto show significant positive and negative association with selected ETFs. Bitcoin and Ethereum are dependent on semiconductor and artificial intelligence ETFs, and Binance Coin on cybersecurity and AI.
The first of the two tests we conducted to test for cointegration was the Johansen test. Both variants of the test were conducted using the trace statistic and the maximum eigenvalue statistic. The benefits of using the Johansen test are that it allows for multivariate vector error correction models and therefore can test for multiple cointegrated relationships. Both tests use maximum likelihood estimation, but differ in that the trace test is a likelihood ratio test of two VECM models, unrestricted against restricted, with different null and alternate hypotheses, whereas the maximum eigenvalue test considers the null hypothesis that the cointegrating rank is against the alternate, that the cointegrating rank is k+1.
The Gregory-Hansen test covers one weakness of the Johansen test, where it assumes time has no factor on cointegration vectors. This leads to under-rejecting the null hypothesis of no cointegration when there is a break in the model. Gregory-Hansen introduces W variable time to allow for three different models with structural change. The three models are level model, trend model, and regime shift model, which has a level shift with trend, and slope change respectively. All ETF data was pulled from the same source and provider for consistency. Data was collected from an ETF product provider. They held NASDAQ ETF with multiple tech vertical ETFs. To prepare the ETF data and cryptocurrency to be tested for cointegration, data clean was required in preparation. To start, we used only closing date values for all the ETFs and cryptocurrency. Then, to get the cryptocurrency to run on a 5-day trading week like the ETFs. This involved removing weekend data and public holidays where trading does not take place in the NASDAQ. This was all done as to run estimation function on missing data would lead to more than 2/7 of data being estimated. The data was finally cleaned by removing all data before 12th of the 2nd, 2018, so all data has the same start date and end date to allow for more focus on recent data than older data.
Initial exploratory analysis of the time series were conducted in order to ensure the data was fit for cointegration testing and able to provide reliable results. First, from the time series plots of each of our processes, we can confidently assess that all series are non-stationary, as clear positive trends are evident. Augmented Dickey-Fuller tests on each process confirm this to be true. Secondly, these autocorrelograms display the presence of ACFs within each time series. Next, we must ensure that seasonality does not exist in our processes, which can be confirmed visually by these full autocorrelograms. We can also rule out the existence of spurious regression by observing no spuriously high R-squared values are seen when regressing each cryptocurrency on each ETF. We previously mentioned that homoscedasticity is very unlikely given the volatility clustering in these markets. Brish-Pagan tests confirm the clear presence of conditional heteroscedasticity in our model. However, as previously discussed, this would not have a significant impact on our results.
As you can see here in the table of Johansen test results, there are a few statistically significant results both in trace and eigen subtests. The critical value used for null rejection was set at 5% significance, as each test failed to reject at 1%.
The Gregory-Hansen model saw some results that contradicted, but also reaffirmed the Johansen test results. There is a 5% and 1% significance level asterisk to indicate results. Cybersecurity ETFs saw no co-integration in the Johansen test, but saw a significant value in the Gregory-Hansen test results for a level trend with Ethereum. This result, however, is questionable, as only augmented Dickey-Fuller test noticed any co-integration, and that further inspection of the graphs appear to contradict this result. One would expect co-integration between cybersecurity ETFs and cryptocurrency, as cryptocurrency relies heavily on cybersecurity, and that any hacks to either crypto or any security system would affect confidence in the other. Interesting to see no co-integration between semiconductor ETFs and cryptocurrency, with semiconductor technology and its industry playing a big role in the production of technology used for the mining of cryptocurrency. However, this lack of connection may be in part due to recent chip shortages that started in early 2020. This has led to the semiconductor industry that makes components from silicon become insulated from cryptocurrency behavior, as markets do not operate normally. This, however, may change in the future as chip shortages reduce and the market returns to normal.
The Clean Edge Green Energy Index Fund ETF saw a co-integrating relationship with Bitcoin in the regime shift model with a breakpoint date of 9th of February 2021 for the Gregory-Hansen test. Both the Johansen trace test and max eigenvalue test also identified at least one co-integrating relationship between the two. A relationship with Binance Coin was also identified by the regime shift model of the Gregory-Hansen test, with a breakpoint of 19th of February 2021. Both these relationships may be due to the significant increase in investment in crypto and clean energy fields. We believe this will increase greatly in the future. As is seen on the graphs to the right, both Bitcoin and Binance Coin peak in relatively similar time periods of QCLN and follow a similar upward and downward trend. The Artificial Intelligence and Robotics ETF was identified to have a co-integrating relationship with Binance Coin in both the Gregory-Hansen regime shift model and Johansen eigenvector model at 1% and 5% significance, respectively. One would have thought all cryptocurrencies would be somewhat co-integrated to artificial intelligence and robotics, as this space has seen a large influx in investment as shown in the blue line on the graph on the right, and application in recent years. AI has become increasingly linked to crypto as it's used to improve mining efficiency and profitability. No co-integrating relationship between Bitcoin and ROBT could have been due to Bitcoin's large price surges and drops in the recent years. Interestingly, no co-integration was found between the NASDAQ 100 equal weighted index fund and the three cryptos tested. This fund includes the top 100 companies across all industries traded on the NASDAQ by market cap and volume. It may be that although specific industries or businesses may have a co-integrating relationship with various cryptocurrencies, together as a whole, no relationship has been found. This could change in the near future as top 100 businesses invest more heavily in technologies used to drive and run cryptocurrencies. No co-integrating relationship was found between the three cryptos and the NASDAQ 100 Technology Index Fund from both models. The top 100 tech firms are not guaranteed to have all the different industries included, as some are far more successful than others, creating weighting imbalances. This may change in the future as markets stabilize, markets such as the semiconductor industry and cryptocurrency markets, as it sees an increase in regulation. A greater relationship could be seen in the markets with both high potential profits and earnings.
So in summary, co-integrating relationships were found between Ethereum and CIBR, Bitcoin and QCLN, Binance Coin and QCLN, and Binance Coin and ROBT. These findings suggest that there are diversification benefits in adding cryptocurrency to one's portfolio, allowing portfolio managers to better understand the co-integration profile of cryptocurrencies with these major technology verticals. However, there is a gap in the literature. The relationship between cryptocurrency and high-performance technology stocks has only been examined briefly, but has provided interesting findings. So more research needs to be conducted on that front.